It's all well and good to say, I'm going to buy all of these properties and I've got all of this debt and look how rich I am. But once you stop working and that wage stops coming in, where's the money come from to spend? You need to work, otherwise the thing all comes crumbling down. So the starting point is to then work out, well, what is it that you want to live off? In this particular case, there's some cash in offset accounts and so forth. So on day one, can retire. Doesn't matter. There's not a huge rush to start to sell assets.
Because you'd live off the cash that's in the offset account.
Because there's cash in offset accounts to buy some time. Now, if there wasn't cash in offset accounts, so that'd be the first thing we'd need to be looking at doing. Need to work out where is the spending money going to come on day one when the pay stops coming in. For someone that's old enough, that may be their super fund. For someone that's under 60, it's going to have to be cash in the bank or other liquid assets that they can use. Then we need to look at the selling down of those assets to pay the debt off, or a lot of the debt. So depending on the level of debt that's involved, generally speaking, that debt has to go. The only way that that's going to happen is by selling assets. We then need to look at the capital gains tax implications of selling those assets and be careful about when we're selling them. The first thing that you want to look at doing is selling the asset in a year when you don't have the income from work. So if you're giving up your couple $100,000 a year salary, for example, now in May or June where we're recording this, and then potentially sell in the new financial year where you don't have that income, so your capital gains then a whole lot lower.
Capital gains essentially just gets added to your taxable income for that financial year.
You're effectively starting from roughly zero, particularly if you've got some negative gearing going on with the properties. You're starting from a zero income, your gain goes from there, so you'll pay a whole lot less tax going through the scales there. And then there's looking at super contributions that we can use to offset some of the capital gain. In this particular case, there's a lot of unused carry forward concessional contributions. You have to have under $500,000 in super. This particular person that we're talking about hasn't been in regular paid employment for a period of time. So there hasn't been super contributions being paid. And so he's got like nearly the last 5 years worth of super contributions that he can catch up all in one go. But one thing that we identified was that his super balance was nearly at 500,000. But if markets had have continued going ahead like they had, he highly likely would have breached the $500,000 threshold come the end of this financial year and would have lost access to that cap. If it went over 500 and then it dropped under 500 the next financial year, all of a sudden you get access to the caps again. Once you go over, you don't just lose them, but you just can't use them whilst your balance was over $500,000 at the end of the previous financial year. He's been able to sell one of the properties pretty quickly, has money in offset accounts, so we don't actually have to worry about settlement, because that's where some people get caught out to say, actually, I sold my property today, but settlement's not for 90 days. If that settlement lands in the new financial year, it doesn't matter. The tax event happened today. And so we need to just get money from offset account into super to claim the tax deduction. The settlement will go through.